Good afternoon, and welcome to Day 4 of Energy Finance 2021 Online. I'm Sandy Buchanan, Executive Director of the Institute for Energy Economics and Financial Analysis, coming to you today from Cleveland, Ohio. Our session today is entitled, Why Big Oil Isn't So Big Anymore. Before we get started, I want to explain how our question and answer session will work. You'll see in the lower right or the right-hand side of your screen a chat box. Feel free to place your questions in the chat and the moderator will relay them to our speakers. You can also use that chat box to interact with other conference attendees. I'm now pleased to introduce Adrienne Bloch, who will moderate today's session. Adrienne is the managing attorney of the fossil fuels program at Earthjustice, where she leads the strategy to develop holistic place-based litigation to phase out oil and gas production in a way that protects health of the communities and the environment and advances equity. She previously directed the legal team at the Communities for a Better Environment, and she's based in Oakland, California. Now let me turn this over to Adrienne to get us started.
Thank you, Sandy, and welcome everyone to today's panel. I am excited to introduce two fantastic speakers with us here today, Clark Williams-Derry and Steve Brown. Clark Williams-Derry is an energy finance analyst at IEEFA who's focused on oil and gas production and markets. For 18 years, he was the director of energy finance and research for the Sightline Institute in Seattle, a multi-issue sustainability think tank, and was senior analyst for the Environmental Working Group. Clark's presentation today is going to focus on market factors affecting the oil industry worldwide. Next, we'll hear from Steve Brown. Steve is the CEO and president of Capital Assets Sustainable Energy Development, a health and clean energy consultancy. Steve was the 2014 Democratic nominee to the Texas Railroad Commission, which is the agency that regulates the oil and gas industry in Texas. The Permian Basin in Texas and New Mexico is the largest oil producing region in the world. Steve is now board chair of Commission Shift, a Texas-based organization dedicated to reforming the Texas Railroad Commission. Steve will talk about how the commission can be reformed to protect health and safety and have significant impact on how the oil industry operates. And with that, we will turn it over to Clark's presentation.
The topic that I want to talk about today is the U.S. oil industry, sometimes called big oil. But the theme of the talk today is really that big oil is shrinking. Big oil just isn't as big as it used to be. The industry's profitability, its financial power, and its future prospects are all in decline. Now, you might not be able to tell this just by looking at news headlines. I mean, over the past few months, we've seen headlines like these talking about a rebound for the oil industry and a surge of optimism. And fair enough, the oil industry is doing much better today than it was this time last year when the COVID crisis had gripped the world economy. Air travel was down, jet fuel consumption was down, driving was down, and in fact, US oil prices briefly went negative. But just because the industry is doing better than it was last year doesn't mean that it's doing well. And you can see that with a longer term perspective. Here we have a chart showing the stock market performance of, in blue, the S&P 500, which is a broad index of large US companies. And down at the bottom, what we have is representatives of the oil industry. In red, it's ExxonMobil, the flagship of the US oil industry. And what you see is since 2010, ExxonMobil has actually declined in value as of the time of this filming. It is the S&P 500 is nearly quadrupled in value from 2010, and ExxonMobil, meanwhile, has lost value. But it's done a little bit better than this orange line, which represents a portfolio of oil and gas companies at the center of the fracking boom, which have lost even more value. So really what this shows is that during the fracking boom in the US oil companies were struggling. They were shrinking financially, not growing. And when we talk about the recovery or the rebound over the past year, that's really just this little tail at the end here. It's not a recovery to back to where it was even in 2010. There are other ways of talking about financial problems of the oil and gas industry over the last 5 to 10 years. One is to look at bankruptcies. This is a chart showing bankruptcy debt and more than 260 North American oil and gas bankruptcies since 2015, with about $180 billion in debt restructured, which mostly means or largely means that a lot of this money is not getting paid back. Investors loaned the money, but they're not getting it back. It's not just the companies at the bottom that are struggling, the ones that are going bankrupt. All companies are struggling to make money in the oil and gas industry in the U.S. This is a chart showing ExxonMobil's performance since 2013. On the top, you have its capital spending, capex, which is basically its investments in oil and gas drilling in the U.S. At the bottom, you have the cumulative earnings. So while Exxon has spent about $61 billion in its U.S. upstream division. The earnings from that division have actually been negative over that period. Now, these and similar problems all stem from the same underlying cause, which is prices. Uh, it may be easy to forget this, but as recently as 2014, oil prices were regularly topping $100 a barrel. And adjusted for inflation, as this chart shows, they're even higher. And more importantly, over time, the oil and gas industry expected oil prices to remain high or even rise. But starting in 2014, something happened. The US started producing more and more oil. It started importing less, exporting more, and that put more oil into global markets. And that brought prices down. And that's what we saw starting in 2014 and really on through today, a reset of oil prices to a new lower level. So even if we talk about a recovery in oil prices from last year's lows, what that really means is that oil prices still haven't gotten up to the level the oil industry thought they were going to be a decade ago. And that's really at the fundamental heart of why the industry is having a hard time making profits. So what happens when an oil industry is not able to make profits, not able to generate revenues? It stops investing in itself. And that's another the hidden side of the so-called recovery over the past year, that a lot of that recovery just represents an industry that's spending less on its own future, that's investing less in drilling. This is a chart showing capital spending by a cross section of companies at the sort of the center of the fracking boom in the US. And what it shows is that over the past several years, even before the coronavirus crisis hit, this was an industry that was investing less in itself. Its investments were falling. It was essentially putting less money into its own future. And this actually helps the industry generate some cash, but at the expense of its future ability to produce oil and gas. So really the coronavirus crisis, kind of accelerated a trend that was already underway. One of the real world consequences of this decline in investment by the oil and gas industry is that we're seeing much lower levels of drilling activity in major oil producing basins across the US. Here's a chart showing drilling in the Bakken, which is in North Dakota and Montana. And what it shows is that since the coronavirus crisis hit, drilling activity in the Bakken has really collapsed and is not showing much signs of a revival. It's a little bit of an uptick since the very low levels of last year, but not much. And this is actually causing production in the Bakken to decline as well. And in fact, in many parts of the US, many oil producing regions of the US, production is on the decline. The one exception is the Permian Basin in Texas and New Mexico, where we are seeing some increases in oil production over the past few months. But I'm going to leave the discussion of Texas's situation to our next speaker. So what we've seen over the past decade is an industry that has been shrinking financially. We've seen over the past year and the past few years that the industry is investing less in its own future. What about moving forward? What are the prospects for the oil industry moving forward? Well, there are several trends that are suggesting that this kind of shrinkage is going to continue. One of those is a look at the vehicle market, and particularly the electrification commitments that have been made by major auto manufacturers. It's not just Tesla, it's GM, it's Volkswagen, it's Ford, and many more. And we're starting to see electric vehicle sales cross over a key 5% threshold. We've seen that in China, California, and much of Europe. Uh, at that point, you start to see faster and faster adoption of electric vehicles. I think we can expect that electric vehicle sales will probably rise in the future, and they will take a bite out of gasoline consumption. At the same time, various climate policies, not just vehicle charging infrastructure, but a whole array of climate policies will start to erode global consumption growth. As a result, many analysts are starting to predict a peak in oil consumption sometime this decade. And some have even gone so far as to say that oil consumption peaked in 2019. We don't know exactly what's going to happen in the future, but the fact that there are more and more analysts, credible analysts, who are talking about peak oil, including oil companies like BP and Total, that's going to start to affect investment trends and affect market sentiment and point towards further contraction of the industry. So let me leave you with a few key takeaways. The first is that the fracking boom was a financial bust. Production was growing in the US, but financially, the industry was shrinking. And it wasn't just shrinking for a year or two, it was shrinking for much of the past decade. The second point I want to leave you with is that this recent recovery that people have been talking about in the news and elsewhere really conceals another story, which is that the industry is reducing its investment in itself. It's spending less money on new production, new drilling, and that actually has implications for the industry's future and may point for much of the industry in the U.S. To a shrinkage of production moving forward. A third point is that there are signs that global oil consumption could peak soon, and that is taking the wind out of the sails of the future prospects for the industry. So, the final point I want to make is that we've heard so much about big oil for so long, but really, big oil has been shrinking. And in fact, I think it's time to say that we've entered an era of smaller oil. Thank you so much.
I serve as the board chair of Commission Shift, a nonprofit that is focused on advocacy around the Texas Railroad Commission, which has nothing to do with railroads, actually regulates Texas's oil and gas. The Texas Railroad Commission has a mission statement that makes three distinct declarations. One, to be stewards of our natural resources. Two, to be concerned for personal and community safety. And three, to support the enhanced development and economic vitality for the benefit of Texans. It is because of this mission statement that I joined groups like Commission Shift to envision a future for this agency that better reflects these principles. It's why I ran for Railroad Commissioner in 2014. And it's why I'm so disappointed by the systemic managerial failures that have plagued this agency. Today, I'll frame my remarks around these three distinct points in the Railroad Commission's mission statement, as they should serve as guideposts for this agency and not just words on the website. When I ran for Railroad Commissioner, I, like many Texans across the state, was concerned about the agency's inability to truly be stewards of our natural resources. I was disheartened by their blatant disregard for community safety concerns. I was embarrassed by their lack of foresight to understand that Texas's natural resources include wind and solar, and that these resources could be better folded into our energy grid. 6 years later, and in the wake of an energy catastrophe that left 4.5 million Texans in the dark, and an untold number of deaths that we'll continue to reconcile over the next coming weeks, we must conclude that stewardship, public safety, and the enhanced development of sustainable resources is still woefully lacking at the Railroad Commission. Events surrounding the colossal failure of leadership and preparedness during Winter Storm Uri bears this out and demonstrates that the Railroad Commission isn't doing very well on the stewardship of natural resources part of its mission statement. Time and time again, the Railroad Commission had been told that frozen wellheads and pipelines would contribute to grid failure in the event of an extreme weather events. These warnings came in 2011, 2014, and 2018 by the Federal Energy Regulatory Commission, FERC, as well as the North American Electric Reliability Corporation. They explicitly stated that water produced alongside the natural gas would crystallize or freeze, completely blocking off gas flow and shutting down wells. Additionally, they recommended that penalties must be imposed for noncompliance with winterization best practices. And they weren't wrong, and millions of Texans know it. Natural gas production dropped 45% during the winter storm. Compressor stations failed to perform due to a lack of backup generation. 1/5 of Texans experienced a loss of power due to the inadequate delivery of gas. That is, the gas supply didn't get to power plants in time to prevent the loss of power for millions of Texans. The suffering will no doubt continue as more extreme weather events loom on the horizon. According to John Gammon at Texas A&M University, extreme low temperatures during winter months exhibit a stronger and more robust trend. Instead of deflecting blame, the Railroad Commission should take accountability in being a better steward of our natural resources, which is the very first point in its own mission statement. As for community safety, what I heard so often from landowners and families throughout Texas while campaigning was, who's my champion there? Who advocates for me? Whether discussing concerns about abandoned wells, seismic activity related to wastewater injection process, well integrity concerns impacting groundwater resources, or property rights. It was abundantly clear that everyday Texans felt like their safety took a back seat to the economic interests of oil and gas producers. A constant through line for years is the question of whether this agency is truly concerned for the community safety, the second plank in its mission statement. Whether in the context of dangerous orphan wells or its refusal to mandate that operators weatherize their facilities. This agency has proven not to hold public and community safety in high regard. As economic factors like price wars between OPEC nations and the pandemic drive bankruptcies in the oil and gas sectors, thousands of abandoned orphan wells are left across the state and become the Railroad Commission's responsibility. Texas used to have a well-funded program to make sure the state was protected from the cost of plugging abandoned wells and cleaning up sites, but the scale of the challenges has far outpaced the revenue stream, leaving taxpayers on the hook. As investment moves away from oil and gas companies in favor of businesses with a better return, the state of Texas faces a significant economic threat. Combined with declining demand from depressed commodity prices, shifting consumer preferences, and the global COVID-19 pandemic, the state faces a surge in oil and gas company bankruptcies and declining revenue from fees it collects from the industry. Meanwhile, the Railroad Commission of Texas, the state's oil and gas regulator, has been asleep at the switch. I believe then, as I do now, that we must channel those concerns, anxieties, and frustrations and transform this agency into one designed to truly prioritize community engagement and transparency in its administrative processes, focuses on the continuous improvement of protocols relating to public health and safety, and implements a feedback loop to inform this agency whether it's getting these core values right and identify areas to course correct. Several data points over the last decade highlight this abject failure to get the concern for personal and community safety part of its own mission statement right. The Railroad Commission should also be capable of demonstrating the foresight to support and facilitate the build out of additional energy resources in this state. Which brings me to the last and final plank of the Railroad Commission's mission statement. Global demand for oil and gas will peak this decade. How will Texas and the Railroad Commission manage its existing energy assets, many of which have been abandoned by operators? How will it support the enhanced development of new energy resources to ensure our continued economic vitality. Texas is blessed to be equally rich in wind and solar resources as it has been in fossil fuels. We'll need to harness the development of these new energy resources as well as distributed generation from electric storage batteries to improve grid reliability during extreme weather events. So in closing, Commission Shift was created to hold the Texas Railroad Commission accountable for adhering to the ideals of its mission. Our advocacy will work to encourage the Railroad Commission to take a proactive stance on issues related to abandoned wells, preparedness for extreme weather events, and support for the development of new energy resources. We all want a Railroad Commission that puts Texans first. I appreciate the opportunity to join you today in this movement and to finally accomplish just that. Thank you.
Thank you so much for your presentations, Clark and Steve. And that was great. I have a question for you, an initial question. Clark, you had teed up a question of suggesting that maybe the decline was not actually occurring so much in the Permian while it is in the other oil basins. And so I was actually wondering if one of you could answer that question. What is happening in the Permian in terms of investment and production?
Sure. So what we're seeing across most of the country, most of the major producing basins, is either flat or declining production. But we are seeing increases, some increases in production in the Permian. It seems to be that as the industry is beginning to reinvest a little bit more in production moving forward, it's focusing a lot more of that capital spending in the Permian. And there's probably some good reasons for this. One is that the Permian is close to the big export markets in the Gulf. And so there's a good chance that the thinking is that if you're in the Permian, you're close to a lot of different markets, both US markets and global markets. And a second reason for the concentration of the Permian is that in general, it's a little cheaper to produce oil, or you have a little bit better sort of break-even pricing for oil in the Permian than you do in some other basins of the country. And that's not true across the board. I can talk about that a little bit later in the Q&A maybe, but in general, Permian is a little bit better economically, and it has better access to some of the potential growth markets.
And what does that mean for the decline overall?
So far, things are bumpy, maybe trending up a little bit. I mean, over the past few weeks, what we've been seeing is, if you've been paying attention to oil markets, oil prices are rising. We're seeing a slow increase in what's called the rig count, which is the number of active oil and gas drilling rigs that are operating in the US. A lot of that increase has been taking place in the Permian in Texas. So, moving forward, I think that we're likely to see some overall increases, but not the same. So far, we're not seeing the same kind of growth that we were after the last big oil crash in 2014 and 16. Fairly quickly, oil prices rebounded, and we started seeing real reinvestment in oil production. We haven't quite seen that happen yet, and that's a signal that I'm waiting for. So far, the industry is sort of exercising what it calls capital discipline, which is another word for shrinking.
Great, thank you. We have a lot of questions in the chat, which is exciting. But first I want to ask you a question, Steve, which is, has Texas learned anything, or what has Texas learned from the crisis, this storm this last winter?
Texas has, and first off, good being with you all. Thanks for having me here on this panel. Has Texas learned anything? I think the general public probably is more aware of ERCOT and the Railroad Commission and the PUC more than they did, say, before February. So there's something there. I do expect and I hope that as many of the members from the legislature who just wrapped up last month, as they began thinking about their primaries next March, that questions about grid stability and resiliency and things of that nature will definitely rise to the top of the issues that they discuss and hear about from their constituents at home. I think it's only through that will transformative progress be made. But to answer your question more directly, it's hard to say that much has been learned. I mean, I think that the legislature did make some tweaks in terms of how it communicates through these disasters, not only to residents of Texas, but also in terms of how it communicates to major players throughout the state, and making sure that folks who are a part of power plants or power plants themselves don't shut down, and that the Railroad Commission knows who they are, so that we don't block out their part of the world, and so they can keep running. There's some question about how well gas supplies will get to the power plant, so that they can keep running and keep performing. But a lot of missed opportunities as it relates to just pure home weatherization, as it relates to some sort of a capacity market to incentivize power plants to have power available at all times, right? And so those real fundamental changes to the market here in Texas were more or less ignored this past session, and will continue to be ignored unless we continue to raise these issues as priorities for the state.
Thanks. Thank you. We have a question from Norm to Clark, which is, do you have a general idea of the differential, with the different formations, the differential price to break even?
Oh yeah, sure. So like the break-even pricing for different basins, kind of, is that the question? Yeah.
That's the question.
So generally speaking, okay, so like it's a little bit hard to make sweeping generalizations about, say, the Permian, because the Permian is actually not just one. It is one big basin, but there are a lot of sub basins and sub plays within the larger basin, and even within a particular play, you might have multiple layers of rock which have different economics. So one way of thinking about this is when you look at across sort of the basins, sort of big areas, the Permian tends to come out as having the best break-evens, or that is, when I say break-even, that is a price at which it kind of makes sense or may make sense economically to start producing oil there. So Permian is generally, and we've seen this in the shift of the industry away from other basins, away from from Oklahoma and from fracking in Colorado and from North Dakota. We see that sort of drift more towards the Permian because the break-evens are better. I tend to think that the Bakken is a step or two behind the Permian, but the real issue here is not so much basin by basin comparisons. The real issue is sort of almost micro-targeting the sweet spots. And a good well in the Bakken, for example, might be as good as a good well in the Permian. The problem is that there are fewer good drilling spots left in places like the Permian, and there are more, places like the Bakken, fewer drilling spots left in the Bakken and more in the Permian. So this is I guess a long way of saying there are big differences among the different basins. The Permian appears to be a leader. Bakken's a step behind that. DJ Basin, a few others are farther back. But really, it's like looking at the overall position of a basin doesn't necessarily tell you the quality of a given well. And there you might be able to find good or productive or economic wells in lots of different basins.
All right, thank you. We have a question from Robert Ukaili, and his question is, the Saudi oil minister said he wants to stop an oil super cycle, and the way to prevent that is to increase capital expenditures. Why do the Saudis not want $100 per barrel oil?
Yeah, should I handle that one, or Steve, do you want to?
Yeah, you can handle that.
Yeah, if you got thoughts, feel free to chime in. So that's a great question. Why does Saudi Arabia not want high oil prices, right? You'd think that would be in their economic best interest to want oil prices to go as high as possible. The problem is that if oil prices rise too high, two things happen. One is that you create more incentives for demand destruction. Demand destruction, in particular, say, individuals, companies, countries investing in electric vehicles, for example, where if oil prices go to $100 a barrel, it becomes that much more economic to power your transportation system with electricity. So the Saudi Arabia doesn't want prices to go too high because it doesn't want to, basically create the kind of incentives that would accelerate demand destruction or shifts away from oil and gas as a main transportation fuel. The second thing that happens when prices are high is what happened in the US shale industry. You could see a boom in shale, again, overproduction, and then prices fall. That's happened time and again. When prices would rise globally, you'd see the US shale industry come on strong. It would overproduce. That would bring prices down for everyone. And it's not just the US shale industry. You could see that happening in other parts of the world. You could see Russia overproducing. You could even see some parts of the world experimenting with fracking of their own. Even places like, in the Middle East, where they have older oil fields that could potentially be fracked the same way. Once you have a clear price signal, that some of that might start happening. Really, the Saudis have the problem. There's sort of like a Goldilocks window. Not too high, not too low. If it's too high, you create demand destruction. If you're too low, you can't make profits from your enterprise. So they're looking for keeping prices kind of right in this not just right zone. The problem is that as the economics of oil change and as the alternatives get cheaper, that Goldilocks window kind of closes.
That's really helpful. So I have a question for both of you. Both of you can answer from Amy Panic. And she says, does the industry escape hatch resemble those of the gas industry, plastics and petrochemicals? And how does carbon capture and storage fit in? How does it fit into the oil industry's financial and economic future? Maybe you can go first, Steve.
Steve,
I'll take the second half of that question and at least provide some insight, and maybe Clark, you can do the other part, the first part. So what we've seen so far in Texas are examples of some demonstration projects using carbon capture to actually be used for oil field recovery types of services, and so you kind of taking the carbon capture and then using it in the oil field essentially. In which case, you captured a lot of carbon, which is great, but you used it to continue the drilling process in another way, right? And so there's definitely trade-offs there. I do anticipate that carbon capture, particularly in Texas, will continue to, I think industries will explore ways to continue to use carbon capture as a means through which to,
maybe green up their,
Was that what
that's a green up their image, kind of?
Exactly. Yeah, that's a good way to put it. To use it in a way to kind of bolster their bona fides, as it were, as it relates to their sustainability plans and goals and ESG goals and all that fun stuff. The question is, what do you do with the captured carbon, and whether or not we're really making a big difference. And I do expect that, this is something that will be done in the margins where you probably will see some incremental improvements. But at the same time, is it what it could be in terms of the ability to really restrain from allowing emissions to and greenhouse gases to escape into the atmosphere?
Yeah, on the whole escape hatch idea, there will be some shifts to petrochemicals as an escape hatch for the industry, as sort of transportation demand maybe levels out or potentially falls. Using petrochem as in the gas industry. And the large reason for that is that, I mean, a lot of these wells, an oil or gas well, produces both liquids and gas. It produces, liquefied petroleum gases, it produces natural gas liquids, it produces gas, it produces oil. And there's a process of, separating out those different subproducts. I mean, it's not just one thing that comes out of a well, it's actually a suite of products or a suite of hydrocarbons. So some of that will, like if you're looking for an escape hatch for the industry, yes, petrochemicals is one of them. There's one potential escape hatch, at least. If that is an escape hatch for the industry, it means the industry will be shrinking because the demand for petrochemicals is a lot smaller than the demand for transportation fuels generally. And when I talk about transportation fuels, I'm talking not just gasoline, but diesel and jet fuel and bunker fuel and on all the whole suite of things. I guess the thing with oil that's unlike some other products is that oil is, as a liquid rather than a gas, oil is just really easy to use as a transportation fuel. So part of the issue for the industry is frankly slowing down the transition from oil-based transportation to transportation that's based on some other, probably battery power. But so to some extent, the escape hatch for them is moving slow, right, rather than shifting the demand to a whole new sector.
Thank you. So Mark Scalise has a question, and I have a follow-up question to his question. His question is, am I correct in thinking that the transition away from oil is directly dependent on success in electrifying the transportation sector? And if so, how long before we start to see solid state batteries and fast charging batteries? And that is a question, again, for both you and for both Clark and Steve.
Yeah, well, Steve, if you want to take a crack at it, I have some thoughts. But...
Well, I actually why don't you go first, and
yeah, sure.
And I'll come in.
Piggyback, yeah, sounds good. So my the question is how, to what is there a is there sort of a direct correlation between electrification of the transportation system and the decline of oil? And I would say there's a very close correlation, or very that is, if you're going to see a major decline in oil demand, you're almost certainly going to see that decline resulting from shifts in the transportation system. That said, there are plenty of other things that oil is used for. It's used in the petrochemical industry. There's a huge number of products that are made from oil. But in general, yeah, if you're going to sort of see declines in oil consumption, that is probably going to be linked to declines in transportation. And again, it's not just cars; it'll be trucks, it'll be boats, and it'll be planes and other things as well. And there are lots of different transition pathways for different parts of the transportation system. The thing, I'm not sure what I can say, if I can say anything about the advances of battery technology, because it's a little bit hard to predict technology trends. What I can say is the cost of just regular old plain vanilla lithium-ion batteries, which at a decade ago were not plain vanilla at all. The costs have come down so quickly and has made electrification of transportation so it's so competitive right now with oil that I don't necessarily think that we're going to need to wait to see sort of a next generation of battery taking over everything. You may need that for some parts of the transportation system, but the big things, trucks, buses, cars, I think that's probably is not going to. We're going to see continued acceleration in the deployment of electric vehicles without the development of a next generation of battery technology. That's what I think. But I'm just a guy, so.
Go ahead, Steve.
And just to add real quickly, I think that the transition probably begins to take shape as soon as we see an acceleration of the deployment of capital, of affordable capital, to reach communities that otherwise might not have access to capital, to begin to this new transition, this new adaptation. I think that, the democratization of the clean energy transition will probably do more to accelerate the transition than perhaps anything else. And so, making clean energy accessible and affordable for everybody, I think, is going to be the first step in how quickly we can accelerate through this transition. And I am happy and confident and pleased that that is a focus of this administration that we have now currently in DC, that they get that, and that, whatever federal resources can be used and deployed to make sure that equity is at the forefront of energy transition and energy transitioning. I think that will definitely have an impact in the acceleration and the pace through which we can accelerate.
Okay, well, I have a follow-up question for you. So it's my understanding that the Permian oil is not that usable for, it's not suited for oil refineries located in the Gulf. And so a lot of it, that's the move. That's why it's so important to export. And there are a number of proposals to export up to 2 million barrels per day out of each of numerous proposed VLCC, very large crude carrier terminals. And so the question is, how, given the amount of oil that's proposed to be exported, how does that affect the calculus on that kind of one-to-one trade-off between electrification?
Yeah, that's a good question. You're right. So in general, a lot of the refineries along the Texas Gulf Coast were set up or designed to use heavier oil from Mexico, heavier oil potentially from Venezuela, from overseas. And then the fracking boom hit, and suddenly the US was flooded with supplies of light oil. And just so people understand, light oil is sort of a thinner, more fluid version of the hydrocarbon. Heavy oil is sort of thicker and more viscous, sort of like more like molasses almost. Different grades of oil they're not the same. They're not the same things. And so only certain kinds of inputs can go into certain designs of refinery. So again, most of the refineries are sort of craving give them agency, but they actually require more heavy grade crude than we have in the US. So what happens is a lot of oil gets sort of exported from the US, and then we import to backfill our need for heavier crude. I think that a lot of the export proposals are betting on, it's almost like sort of like giving yourself an option for what might happen in the future. One option is, let's say US gasoline demand plummets because all the major car companies start selling lots and lots of new vehicles, electric vehicles. That then they would have the option of selling excess crude on global markets. Or alternatively, let's say the prices go really high, and even if US production, US production goes up again, even if battery technology doesn't take off, there may still be a lot of extra oil that's looking for a home. So a lot of these export projects are basically giving the oil industry an option for the future to sort of deal with what might happen in various economic scenarios. One of the problems with that we've seen, I actually have done a bunch of work on the coal industry, is that you might build a lot of these export facilities and then see the market plummet, and then so it creates potentially a hugely risky enterprise to develop all the infrastructure that you need to create exports if you aren't sure in the end that the demand is going to be there. So I think they're facing a financial risk that they're going to be putting a lot of money into something that doesn't actually pan out over the long run.
Thanks, Clark. Well, I have a question for you from Sarah, who is from Fossil-Free California, Richmond. And this question, I'm not actually sure who we should go to, but it's, what are the odds that the Biden administration will actually stop subsidies to the oil industry?
Hey, Steve.
What would you base your response on? Coming up with a response, what would you be looking at?
I mean, well, I'll just say, I think that what are the odds? I don't know how to measure that and how to answer that in terms of the probability. I will say that I think that the probability does increase as more folks like the questioner and organizations that she represents and similar organizations as they continue to raise this as an issue. I do believe that there are progressive voices in Congress who will not give the administration an easy pass on this issue, and I think that pressure keeps it on the table and keeps it a point at least for negotiations. I think that we're also looking for money to do big things to rebuild this country. And obviously, subsidies work against the ability to deploy federal resources for things like a grid of charging stations along our highways or something of that nature. And so I think there are a lot of factors working in favor of the administration, wanting to work proactively and progressively on this issue. However, I do believe that it's something that we have to keep on the agenda and on the radar, and begin to amplify. What happens when the subsidies go? What could happen when the subsidies would be eliminated? In terms of what it does to the oil and gas industry itself, as well as what it could possibly do for the coffers, the federal coffers, and those resources can be redeployed somewhere else.
Yeah, I'll just add. I mean, there's a lot of different things people talk about when they think about subsidies. One, in the oil and gas sector, there's a specific tax provision, the intangible drilling cost deduction, which sounds completely arcane and is arcane, but it's actually really important to the finances of the industry. But there are other forms of subsidies that aren't just in control of the federal level. There's like roads building, and which is a big deal in some parts of the country, where you're basically having to rebuild roads to get sort of drilling equipment to the drilling sites, and that winds up falling on. It's more of a state expense rather than a federal expense. Obviously, there's like the use of federal lands. Probably the biggest subsidy is essentially the lack of any price on emissions. That basically the industry right now gets to use the atmosphere as a free dumping ground. A lot of these things are going to be tough to implement just through regulatory processes. They're going to require legislative changes. They're going to require changes not only at the federal level, but also at the state or even local levels. So subsidies is a huge question. We probably don't have time to get into it, but I guess my bottom line is I'm not sure that the Biden administration can just, like check a box and have it be done. It's a lot more complicated than that, unfortunately.
Yeah, it does seem like there are a lot of different types of subsidies.
Right.
And I have a related question. Well, it's somewhat related from Zipporah Berman, which is, in your opinion, what are the potential regulatory changes that would have the biggest impact on increasing costs, viability of new projects? For example, bonds liability, toxics, water, methane for fracking. What are your thoughts on that? And that is a question for both of you, and maybe Steve, you can start since you're close to the ground there.
Yeah. Can you repeat the question, Adrienne?
Sure. What are the potential regulatory changes that would have the biggest impact on increasing costs or viability of projects, of new projects? For example, bonds, liability, toxics, water, and methane for fracking. So what could have the biggest impact? What regulations?
I'm curious to see what Clark's answer is, but I would say basically all of the above. I think that the industries that we're focused on now are obviously very diverse. Different companies are in different stages, and some may be able to kind of sweat out increased regulatory mandates, while others might falter, immediately if something were to be enacted. Obviously, I think you're looking at, say, oil and gas and coal. I think probably on the coal side, it probably won't take much for those folks to tap out and say that perhaps this isn't the industry we want to be in anymore. And so I think that there is a probably low bar as it relates to the coal industry. But I would say an all of the above approach, and of course, that would probably just mean that the smaller actors will be the ones impacted first. I think the question is, and I'll pose it to Clark, in terms of the worst actors, what types of regulations might Congress or state legislatures enact to get to the worst performing actors immediately, in addition to weakening the industry as a whole. And I think that there are a lot of things to explore, but I think that there probably that probably should be the focus of any policy pursuits is identifying the worst, the bad polluters within the system, within the ecosystem. And doing whatever it takes to weakening them first and getting them out of the market. Of course, just enhanced penalties. Here in Texas could be a big driver for us. I mean, we barely penalize any of the bad actors, and so actually having some enhanced penalties that will hurt the bad actors here will go a long way. Clark?
Yeah, it's a really good question. It probably requires, as you say, there's for different parts of the country and different kinds of projects, different kinds of, like local circumstances, different things will have a bigger impact. But I've always liked methane regulation as something that we need to focus on, because it's sort of a double whammy in a way, because methane leaks from, it's a potent global warming chemical. It comes out of the ground and sort of leaks throughout the entire system. And of course, for many companies, it was essentially an unwanted byproduct of oil. They were drilling for oil and they're getting gas along with it. They didn't want it, so they'd either flare it or vent it. And so really ratcheting down on flaring and venting would be a great way of having an immediate impact on the cost structure for the industry, because they'd have to pay to do the stuff to stop the flaring and venting, or at least reduce it. And then so you get the financial impact that sort of internalizes those costs, and you also get the reduction in the emissions from that. So it's sort of always felt like a win-win on that one. One of the downsides of focusing on methane, ending methane flaring and venting, is for a long time that was sort of, a lot of that was happening in the Permian because there wasn't enough what's called takeaway capacity, or enough pipeline capacity. They've added new pipelines now to make it easier for them to get the gas to market, which makes it easier for them to trim methane emissions, cut back on flaring and venting, at least in theory. And you may wind up with just more of that gas being sent to market rather than and also having less of a financial impact because the pipeline's already built now. So I haven't taken a good hard look at what I would do now that there's more pipeline capacity or takeaway capacity in the Permian Basin. But that, like, methane always came to the top of the list for me, or one of the top. I'm also a big fan of making sure that the industry has financial resources set aside to pay for cleaning up after itself. And this is something that Commission Shift has done quite a bit of work on. And I think Steve's presentation mentioned, is just the whole problem of cleanup of oil and gas wells after the end of their useful life. It's expensive, and the industry is really not setting aside enough money to guarantee cleanup that needs to happen. And so that's another thing. We might have a double whammy benefit of cleanup and also making sure you're internalizing those costs now.
Interesting. And I wonder if waste, regulations might also be helpful.
Similar situation. I haven't tracked it enough to have an opinion there. But yeah, it's the same basic idea.
Well, we have a question from Ben Aliff, who he has a question that's similar to a question I think a lot of us have, and I'm seeing here. which is, do you think oil and gas majors are really set up to transition away from fossil fuels? Despite all the talk on net zero by 2050, are these companies really institutionally, philosophically, physically capable of making or willing to make the kinds of pretty radical changes that will be needed in order for them to play a role in meeting global climate ambitions? And so that's his question. And then there are also kind of the more specific questions, which is a more specific question that maybe you could answer, Steve, is what is Texas doing to make that transition? And this might be our last question. So.
Yeah, and I'll be quick. I mean, that's a great question, and along with all the other great questions we've received today. But the short of it is that I think that, and I'm hopeful that anecdotally, in terms of being in the energy capital of the world here in the Houston area, that from what I've heard from the majors is that they are serious and that they understand that their own livelihood and viability into the future depends on them taking this seriously. While at the same time, I also know of pretty heavy hitters who will, on one hand, they'll be the sponsors for Climate Week, and then on the other hand, have polluting coal plants right down the street, and so those things don't necessarily even out, right? And so, yeah, I am. I think what we learned this week in Geneva is kind of a verified, then trust type scenario. I think that's kind of where we are as activists and researchers and scholars. Is that yeah, we should probably verify that they're making the steps. And then trust that they're making those steps. And as it relates to Texas, Texas is going to Texas until we change the decision makers here. And we have not been able to do so because they control the maps, and they control the maps in such a way that they get to pick their voters. And so until we make some very structural changes to the elections here, I mean, it's not because we are a red state, it's just because of the way that the deck is stacked. But until we make some real structural changes to the electoral system that we have in Texas and rural reforms, I fear that there will be an outweighed or over dramatic influence by the big majors and their ability to impact policy for their own good, which may and will definitely lengthen the time period through which they pursue the status quo and aren't actually forced to make the changes that they are proclaiming that they want to make by 2050. I hope that answers your question. That was a very good question, and I could probably spend a lot more time on it, but I don't want to steal from Clark here.
Well, thanks. I mean, I might actually come out a little bit harder hitting and say, no, I don't see evidence that the big oil companies are really taking the steps that are actually necessary. I mean, the closest ones might be BP or Total, but even there, the steps are small, they're incremental. I think they these were doing some good lip service, but the reality is, like it was covered recently, that BP is one of its major ways of becoming a lower carbon company, a so-called lower carbon company, is by selling off assets to other companies, which may or may not have any impact. It would have not very much impact on how those assets are actually managed in the future. And I think that, frankly, I think Exxon and Chevron in particular have been real laggards on this, and they don't have any realistic long-term plan to go to net zero. So the one thing I can say sort of more generally about this sort of process of big oil we started hearing about Shell selling out of its Permian Basin assets. Those aren't particularly good assets, but there are moves for companies, these big companies, to start to sell off pieces of their assets to other companies. One of the things that does is overall it winds up raising the cost of capital for oil and gas development. A company like Shell has access to cheap money. It can borrow money, it can use self-fund, and so it doesn't have to have as high, it doesn't pay as much for interest. It doesn't pay as much to do these developments. As you shift to smaller companies, you actually wind up raising the cost of capital. The cost of capital winds up in effect making certain kinds of projects economically unviable. So I think there's actually sort of a systemic economic impact of the big majors gradually pulling out of parts of the US oil production system and probably global production system. It may not have as big an impact as I think you might want to see, but there is an impact there on cost of capital, which is something to keep in mind when you're trying to think of, like how to evaluate the impacts of the oil companies, say, selling out of the Permian.
Thank you so much. I wish we had more time. I have questions about how to kind of push that along. I've got questions about divestment and how we might move that along, but I think we've got to wrap up here. And I want to thank everyone for all of your questions today. I'm sorry we didn't get to all of the questions. Thank you so much. And also thank you to Steve and Clark. And with that, I'd like to hand us back to Sandy. Thank you.
Great. Thank you so much, Steve and Clark and Adrienne. That was a terrific discussion on the dynamics affecting the oil industry. We are thankful for all of you for joining today, and we hope that you will stay on for another 10 minutes and watch the video we're about to play, which is the second in our series on local leadership, global change, and it explores the extraordinary work being done on energy issues in Bangladesh. We also hope you'll join us again on Monday for our next session, Petrochemicals, Overcapacity and Community Opposition Challenge the Industry's Growth Dynamics. Also, please feel free to join any side meetings next week that you see on your agenda or to propose new meetings for next week. Thanks again and goodbye.
This is Sharif Jamil. I'm an environment activist. I organize people's movement to protect the environmental degradation. I have been working for the protection of Bangladesh environment for about 2 decades. I work nationally with Bangladesh Paribesh Andolan Bapa, Bangladesh Environment Movement. It's a civil society platform.
My name is Rizwana. I'm a lawyer. I work for a group called Bangladesh Environmental Lawyers Association. It's a non-profit organization. This organization is working to promote and popularize the notion of environmental justice. So we work with communities who have environmental grievances. We take their causes to the court. We also file public interest litigation on important environmental issues.
Bangladesh is part of the largest active delta in the world, and entire Ganges and Brahmaputra river systems go to the Bay of Bengal through Bangladesh. The entire country is formed from the silts of the river. The people, livelihood, economy, everything is run by river.
If you talk about climate change, Bangladesh is one of the most vulnerable countries. If that happens, the way it's being feared, the way it's being predicted, then 1/3 of Bangladesh will go underwater, which means that we will be losing 21 of our districts. At the same time, the entire coastal forest that we have will also be gone. We will have to redraw our map, and that map will not have the presence of Sundarbans, the world's largest mangrove forest.
The heritage of this nation is agriculture. It's a fertile land, and that's why there are so many people here. So we should have a plan that would grow our economic growth through agricultural development. But we did not do that. We decided to grow the economy through industrial growth. And power and electricity is the basic for industrialization. So this government came up with a power system master plan in 2010, focusing on coal as the major source of total power sharing. They decided to develop some major hubs from where those plants will be coming up. And we came to know that a major hub is right on the Sundarbans, a global World Heritage Site.
If that plant is in operation, we fear that the entire Sundarbans will be gone. If this Sundarbans is gone for this 1,320 megawatt thermal plant, then we will be losing a global heritage. It's not something that Bangladesh owns. And if this Sundarban is gone, it's not only one forest that we'll be losing, it's an ecosystem that we'll be losing that has been protecting the coastal people from onslaughts of disasters like cyclones. It is the home of Royal Bengal tigers. So with Sundarbans, with the forest gone, that ecosystem will be gone, the home for the Royal Bengal tigers will be gone, and the coastal people will be losing the natural shelter that they had against some of the natural calamities that are very frequent and very often in coastal districts of Bangladesh.
You cannot fight with the nature like this. We protested it, and then we came to know there is another one half very close to the Sundarbans, also from the other side, in Patuakhali district and Borguna district, which is called Paira Hub. You know our national fish, Ilish. Ilish is very, very sensitive and very distinct fish species. And they are setting up at least 3 coal plants right in the middle of one of the largest fish migration channels of Bangladesh. And we looked more and we found another one hub, which is in the Cox's Bazar, the tourist capital of the nation and the backbone of salt industry of the country. This ecological degradation has not necessarily only have impact on the ecological and natural treasures. It is also important because this country is densely populated country. When you are polluting its air, when you are polluting its water, it is impacting health in terms of mass rights violation.
The official name is something like India-Bangladesh Friendship Coal Plant. But we very popularly call it the Rampal Coal Power Plant. A significant part of the construction has actually been completed. The government and the entire country are divided on this. While the government is sticking to its plan to go ahead with it, it has taken this particular plant as a prestige issue for it. The rest of the country seems to be opposing the plant. But the government is still going ahead with it because they actually had to concede to public opposition in Fulbari, where they wanted to go for open pit coal mining. And they also had to abandon another plan because of public opposition. So whatever opposition is taking place here in Bangladesh, they are sometimes taking repressive stance against the opposition to suppress the opposing views. And this particular plant is being built by both India and Bangladesh together. Had it been in India, India would have never allowed this to happen because under the Indian national law, you can't build a thermal power plant within 20 kilometers from a protected forest area. So something that would not be allowed to be built in India is being built in Bangladesh. Whatever lobbying is being done globally, it's not the Bangladesh's political weight that's being thrown in the international gathering only, it's India's political weight that's also being used to counter those arguments. I think for Bangladesh government and India government, they both want to convey messages to their constituencies that no matter what, they'll be proceeding with the dirty energy. So the main 2 aspects of environmental justice, meaningful participation and no disproportionate sharing of burden, those are being denied both in the case of environmental justice and in the case of energy justice. We don't have a say in the entire decision-making process. But the civil society is putting forward concrete plans. Civil society organizations who are operating here in Bangladesh, international expert agencies are painting the whole canvas about how Bangladesh can give up its dirty energy schemes and actually can move to a much better renewable production of energy.
Bangladesh is in such a crossroad now. It's a densely populated country, a lot of food you need. It's in the economic crossroad, it's growing. We need to keep it continued. But we also need to think very carefully what the impacts are coming up after 10 years from this development. If you see the rivers around the capital city of the country, all those rivers are dead. There is no aquatic life. It's all polluted because of these unplanned industrializations. We activists want to make a bridge between the people and the policy making process. So what we do, we go to the people, we tell them the truth because we work together with the scientists and researchers. We know the information from global communities like IEEFA. So we take information, we give science, we translate those into people's language. We found IEEFA was the greatest help. They give a report in 2016 on the possibility and feasibility of Bangladesh's energy transition towards renewable and sustainable energy production. We organize meetings at national level. We bring ministers, we bring government high officials who are involved with this. We bring academicians and researchers and we discuss about it. We sometimes go to the court because sometimes some voices are not heard enough. We are not protesting the nation's development or anything. We are only assisting. We are only trying to help it more sustainable and more helpful for the nation.
The hope is people actually are getting more aware about the need for a sound environment. We have seen the price of unregulated development and we don't want it anymore. You can have polluting industries in hundreds. You can have mega projects in thousands. But once you lose a forest, once you lose a river, you'll not be able to recreate it. It is important that we continue our critical role so that the development agenda is redefined to actually serve the people.